if you remember, I was showing you, watch this wick here. Yeah, drew that line here at the midpoint, which is 118.817.75. And I told you lots of values in here. See how it's showing you it's respecting what? It's respecting the high of the inefficiency. And then here's that wicks constant encroachment, hits it there and delivers down into this range. That right there is enough for a scalp. And that's enough to do what a lot of the guys on YouTube do, like these small tiny price fluctuations. So if you have an entire time frame inefficiencies on your chart, and you're watching how price is moving, gravitating towards short-term sell side, buy side, you don't even need to have the full range delivered. You can get these little bread and butter type, easy bread winning scalps. Just get them, you can take them and run. That's all these high frequency trading algorithms are doing. They're finding these price points here, and when they get the data that supports it, it's referring to all the bodies here. The opens and closes have to match. What's it matching? The high that inefficiency I gave on the daily chart at the beginning of the string. And it delivers, gives you one more chance to use that constant encroachment of this 1 minute candlesticks wick. You don't see it, but you get it right there, and delivers lower. Just that alone, that's a high frequency scalp. And they're doing these things all day long. Remember, this is a 15-second time frame. How many times is price using the PD arrays I've outlined here today, and the fluctuations moving back and forth? They don't need directional bias. They're not trading in a one direction only. You know, it's multi-dimensional, so it allows them to be very liquid and fluid, and in and out, in and out. So that's what I'm saying. That there's always liquidity. Always. It's not just above highs and below lows, but there's smaller microstructure that you have to be aware of. And if you look for these types of things, what will happen is if you're using like very small time frames like the 15-second chart or 30-second chart, it helps you decide what you're looking for because you've got a lot of examples inside of one daily range. So look at all the fluctuations here. I mean, if I would tell you that the Nasdaq is going to move 1,500 points today, would you believe me? Chances are you're not wrong. Yeah, that's what it's stretched out to. But if you add up every tiny fluctuation from up, down, up, down, up, down, it actually does more than that. So from a quant standpoint, and yes, I'm familiar with that, and a lot of people like to troll in the past on this and that. Quants understand that dynamic. They don't have to have a daily range that's determined with the directional bias. It's good for you as a retail trader to learn how to do that. So keep this up here. The a high frequency trading algorithm can operate without having a bias. All it needs to do is frame very specific reference points, and then when it gives a confirming quality measurement, meaning that if we know that this inefficiency is marked here, as I'll show you at the beginning of the stream, and I'll show you in a minute before we went on a minute before we close the stream 10:30. I'll recap some of the things that we can go back to your charts, Caleb, and use this video as well. You'll have to use my charts in this regard because it does have the full package for live data on TradingView. So you'll use my charts, you'll screenshot these, and then we'll be discussing work tonight. This is the conversation we'll have. But the bodies are respecting these key levels. And when we see things like that, for instance, like up here, we're looking at inefficiency in the opening range gap on a chart. And where the bodies are closing here, that tells you it's respecting what? The high of that inefficiency. So it's likely that it will explore the other side of it. Other side of what? The inefficiency. Well, if it's going to go down to the bottom of that inefficiency, what's in close proximity to that low? So we'll be resting below that sell side. So they can get in here and aim for that little tiny structure between the new day opening gap of September 11 and accomplish the run below that low for sell side liquidity. So it's accomplishing two things. It's using these PD arrays that I'm telling you to focus on, and then think about a narrative. And a narrative doesn't have to be for the entirety of the daily range. It doesn't have to be for the session. It can be done on micro market structure like this. Small little tiny fluctuations that you can use to parlay and compound. And you can have a very, very small count. Very, very small count. And use just micro lots. That's not even, you're not even trading with big leverage. But you can do a lot of these types of setups, and they can compound over time. And what happens if you use that structure, this approach, and you're finding maybe 2 or 3 of them a day. 2 or 3 of them a day, and you're gaining anywhere between 1.5 to 3% a day. Think about that. But you're out there trying to swing the bat, trying to get 10%, 15%. And you don't even know what you're doing half the time. So what I'm trying to teach Caleb is there is a plethora of opportunity every single day. Even in ugly price action, you can use a 15-second chart. But the problem is, you as a viewer, as a new student, if I tell you these types of things and I show you a 15-second chart, immediately you want to sign up to TradingView or the equivalent and have a 15-second chart and try to trade every optimal trade entry, every fair value gap, every potential inversion fair value gap, every order block. And then because you don't know what you don't know, you end up hurting yourself and you think, well, this is too complicated. But it's really not complicated. What's complicated is you're not settled in on what you're aiming for, what you're searching for in terms of a model or setup. All you have to have is something that's going to be a catalyst for sending price higher or lower. What's the factor that you're looking for in price that's going to constitute a reason to expect price not going higher, not go sideways, but do go lower? Or why should it go higher but not go sideways? But I guess I said that wrong. Let me say it slower. This is where the Control M on Camtasia Studio would be, and I'd go in and say it again, and then I'd go back into the editing part, cut that part out and leave the part I was supposed to say correctly. So we're looking for something that would promote a discount array to keep price from moving lower, but not go sideways, allowing and affording buy-side delivery. That means moving higher price. Or identify a premium array where price should not go any higher, but do not go sideways, but affords the opportunity for sell-side delivery to unfold in price or move lower. Okay, so that's essentially what a high-frequency trading algorithm is coded around that logic. That's all it's trying to do. It's not trying to be in there capturing the full daily range. There are algorithms that try to capitalize on that, but it's primarily in there with lots of transactions all day long. It's constantly firing off. And one of the advantages of having those in the marketplace where they catch a lot of flack. You know, people don't know how to reprice or understand how these markets actually book price. They'll vilify algorithms. Algorithms are messing up everything. Algorithms are actually making things a whole lot better. They're providing a great deal more of liquidity, and that should be smiled upon. But when you're looking at the junkie public who doesn't really understand what price is doing and how it behaves, they're always looking for some external source to blame when they lost money because they over leveraged, they gambled, they overtraded, and or they simply don't have a model, they don't know what they're doing, and they think just by pushing a button like at the casino they're going to get a jackpot. So when you look at things soberly like that, it's refreshing, number one, because it's not something that you should be fearful of. You should be thankful that there's a whole lot more liquidity in the marketplace because of their presence. They're always constantly buying and selling. It's not just they're only buying today or they're only buying right now. They're selling, they're buying and selling all day long. Boom, boom, boom. So knowing what you're looking for, you know, for instance, again, I told you the 5 minute, 1 minute candlesticks wick right here. Thanks, what I say here. That low up to that high, 18.75. Okay, that's what I'm hiding with that little line that I drew across earlier, right there. Look how it came up and hit that again, right there. That's a turtle soup. Old high, hits it. What's it going to do if it goes there? Well, it can run down to that, and and then target the lows I told you that my eye was drawn to here, and then that consequent correction of that wick down here. So if ICP could be personified for a moment, you can see that if I was a high frequency trading algorithm, that's what you get. All live in front of you, explained. Make a meme about it. And you're out here looking at silly stuff, looking at indicators and whatnot, moving averages and VWAP. None of that stuff is what's making price go up and down.